All right, hi everyone. In this lesson, you're going to learn how to invest in the S&P 500 using more technical analysis, and where it's kind of similar. It's different from dollar cost averaging because you're not going to be investing the same amount per month. Maybe you might be investing several times per year, but you're always going to be entering like at, let's say, the best time for technical analysis, right? And then when the index goes down more, right, in technical analysis, the more you're going to invest, right? So this is a different approach. And in this approach, there's two ways to do it, which I'll talk about eventually in terms of investing. Also, by this point, you guys should have learned all about technical analysis with the indicators and movements and strategies, right? The technical analysis formats is this exact same format I use for any trading, whether it's stock trading or option trading. The same formats I use for investing because we're just doing price movements. It's the same formats, the same short-term movement or the same long-term movement. There's nothing different about it. So by this point, you guys should have that already cleared up. All right, so let's get started. Let me talk about first index investing on technical analysis. So let's cover first the technical analysis. This is the S&P 500 and it's on weekly. Let me go on daily because you're most likely going to be doing this on daily rather than weekly, right? And by this point, you guys should learn how to use Thinkorswim and different brokers, right, by the platform. The markets are going up, right? And it's been going up. Let's say this is a span of a year, right? This is 1980, right? And then this was the end of 80 and it started in 81. So this was entirely 1980. It was a bull market. It was a bull run. Let's say by 1980, you decided to invest all the times when the market would hit the 50 moving average or the 100 moving average. And each time it hit the 50 or the 100, let's say that by the 50, this is as an example. Let's say from your income, like the $15,000, you have about $6,000. But let's say in this scenario, you're going to be averaging your position because the markets never go up in a straight line. It goes up and down, right? So let's say I usually recommend an interval maximum of 4 times. So what does that mean? What that means is, let's say you're making 15,000 per month and you're putting 6,000 to invest because it's 40% of the income above. And in the 6,000, let's say, for example, you were going to do an interval of 4. So what does an interval of 4 mean? Well, it means that if you have $6,000 to invest with that money, each time you're going to buy a fourth of that amount to invest. So a fourth would be really, the best way to do this is just grab the total amount and divide it by 4. Really, in other words, this just represents the really 25%, a quarter. So it would be $1,500, right? So in this example, when the market went to the 50 moving average, you would invest $1,500, right? You would invest $1,500, right? So that's the rule here. Yeah, that's the rule. That's a basic concept. Now, I would say, obviously, if you invested $1,500 afterwards, the remaining amount is $4,500. If you divide that by 2, 2,250. Here's a pretty good rule, which is what I was about to say. Let's say that from here you bought $122 in the S&P 500, right? And you put in this case, you wouldn't put 25%, but let's say you put in about 10 to 15%. Let's say about 15%. 15% of 6,000, it would be about 900. So let's say you decided to put $900 here, right? And then the next time it hits the moving average, you put in another $900. You would put $900 here, $900 here. So you have about $1,800. You're left with, oh, my bad. So you're left with $4,200, right? But then this is what I was going to say. As the price goes lower towards the lower moving averages, the more you're going to invest. So that's why I keep saying a general rule that you could have, if we go to this tablet here, we could say, okay, if the price hits the 40 EMA, which is the moving average, you would do 10 to 15%. 10 to 15% fund, right? And then when it hits the 100, you could put 15%. So like you see like the concept that you put like 15% to 20%, right? And that as it gets lower and lower and lower, when it hits the 150 EMA, you would enter with 20% to 25%. And as it gets to the last one, you can do, I would say, yeah, the best is really to do 30% up to 35%. Right, so you have it's a pretty basic rule actually. It's actually not that hard to kind of remember. It's pretty simple. And also, this is very effective. You want to know why? Because as the price gets lower, the more you're going to invest. And we all know that as the price gets lower, the lower chance it's going to go lower. So that's just really great because this is actually a bit similar to dollar cost averaging, only that it's a bit more, let's say, cost advantageous. Because rather than entering regardless of where the price is at, right, you get to enter when the price is low. So relatively, the chances that the price are going to be lower are lower, right? Because you're entering when they're already low. You're entering here, you're entering here. So let's say that you entered here 15%. Over here, so here's the basic concept that I have. The more the moving averages are hit, the same moving averages, the less percentages you want to do. So what I mean by that? Well, let me show you. If the 50 EMA is hit 2 times, in the first time, you're going to put 15%. Okay. And then the second time, you put in, let's say, instead of 15%, you'll put in like 13%. Right. And then the third time, you'll put in about like 10%. Yeah, about 10%. And then anything more than 3, you're just going to keep doing 10%. Now, why does it get lower and lower and lower? Well, because look, the price can go anywhere. You can never predict anything. So even if the price is hitting the same point, there's still that probability that the price can go down lower. And you want to make sure that you can have enough funds that you can fund even bigger when the price comes down, right? So that's very effective. Now, one of the things too that I would do, especially that's even more effective, is this. I actually, in technical analysis, in trading, you obviously want to enter when there's a rebound. However, because this is index investing and really investing in general, I wouldn't even care if there's a rebound. I only care if the price is really touching or very close to the moving averages. I don't care if there's a rebound. I don't care if it's bearish or bullish. I just care that it's hitting. You want to know why? Because the price sometimes rebounds when there's no rebound signals. That's just sometimes that happens. So I want to damn make sure that I can get the price filled, even if the price does respect it or not. Because nonetheless, we're entering at a cheap price. And if the price goes down lower, we're going to enter more. So it doesn't matter because this is all in the long term. You're going to make a gain in the long term. So you want to make sure that you enter at a relatively area of the price is hard for it to go down more, hence making a higher chance to go up higher, and that you're still having the benefit of entering at a cheap price, right? But if the price goes down, you're not going to lose at all because it's all in the long term. In fact, you're going to win more because you're going to buy at a cheaper price with more money involved. So look, the price hit the same area. The price hit 2 times the 50. And you know what? I'll do this. Actually, yeah, here's the best thing that you can do. When I mean that you shouldn't wait for a rebound, I mean you shouldn't wait for a rebound that's confirmed. What I mean is, like, you don't have to wait for a hammer or one white soldier. I would say that, a general concept is like this. Look, this isn't a valid bullish reversal pattern because this isn't any pattern whatsoever. However, there is some bullish behavior here because the price is, let's say, correcting this red one, but it's not a strong sentiment as much. But that makes a chance still that the price can go up. So whenever you see that the price is, like, let's say, reversing, but not completely reversing, but reversing like over here, at least patterns that we haven't teach, which are, as long as the next candle is green or a hammer, just enter, right? Regardless of its size, it doesn't matter. As long as the next candle is green, there's still that chance the price can go up, right? And if the price goes down, no worries, because that can still go down. And if it goes down more, like it did over here, how much would you put in the 100 moving average? Well, you would put here 20%, right? Really, what I would do, what I will tell you is, if the price, because look, at the end, it is hitting the same moving averages, but I will tell you this. If the price is hitting the same moving averages, but you see that the price is hitting almost the same share price, because look, it's hitting, like, this was at 125, this was at 125, this is 125, 125, 125. But net, all these prices were actually hit at the 100 and 150, and that's because the moving averages got closer to the candles, and so that the candles didn't move as much, just that the moving averages went towards the candles. So I would say this: if you put 13% here because it hit 2 times, and let's say the price hit the 100 moving average, but if the price is potentially reversing and it's at almost the same price of what you entered last time at the 50 moving average, this entry that you're going to enter here, I would say you should enter the minimum, which is 15%, right? Enter 15%. And then over here happened the same thing. It hit the 150 moving average. What's the minimum there? 20%, right? And then the price hit here, the 200 moving average, but it's the same price. What's the minimum there? 30%. So really what you have here is you entered here, which was 15. You entered here, which was 13. You entered here, which was 15. You entered here when it was 20. And you entered here when it was 30. There you go. You see, like that's perfect. And it's very strong to have this, right? You allocated about 93% of 6,000. How much is that? So you put in $5,580 to enter, all in the span of September till February. So that's about like 10, 11, 12, 1. It's like about 5 months. In 5 months, you were able to fill in your whole investment, right? So let's say that now this completely depends on how you can get money and how fast. But let's say that you can get 15,000 per month. What I would recommend is do it like this. If you can get 15,000 per month, then I would say if you made 15,000 per month, you have 6,000 to invest. If in the next month you had 15,000 again, and you've only allocated 15%, you still have 6,000 extra to enter. So you have about almost 12,000, right? So the 12,000 you have, so you can be with me, right? The first month you made 15,000, right? 40% of that you invested in it. You invested into the S&P 500. So it's $6,000. In that $6,000, you invested about, in the first entry, 15%, right? So you have left about $5,100 left to invest from the first month. In the second month, since you got the same money again, 15,000, you have 6,000 now an extra to invest. So that would be, I mean, you guys know what that is. That's about $6,000 now. But if you add that with the remaining to invest after what you invested in the first part, you have $5,100 still. Net in total, you see you have 11,100. So why is this important? Well, because the second time that you enter, you're not entering on the percentages now on the first amount. You're entering on the full amount that you can invest. So since you don't have $6,000 anymore, you have $11,000. You could enter with 13%. Look, 13% of that is now $1,443. Rather, this amount with 6,000, that would have been like 24%. You see what I mean? You see what I'm trying to get at? 13% of this, net in total, you're able to invest more, right? So by this nature, you're going to have compound interest too. So what does this all mean? Well, you can see that, to be honest, this is actually not so different from dollar cost averaging, but it's somewhat a bit advantageous compared to dollar cost averaging. But look, nothing is perfect and there's nothing better than the other. This still has disadvantages. Why does it still have disadvantages? Well, because if the price is going up like as it did over here, you'll be missing out if you bought here at a lower price and missing out all this gain by just dollar cost averaging, because you're only entering when the price is hitting one of these stronger moving averages, right? So the amount of investments that you're going to do, most of all, will be less compared to dollar cost averaging, because in dollar cost averaging, you're just entering regardless of wherever the price is. But in this one, you are entering depending where the price is at, which could be at one of these moving averages. So net in total, you have 93%, right? But what's the advantage of doing this? Well, that you enter more likely a cheaper price than entering wherever the price is at. But again, this is very great because it can vary sometimes, because a person who doesn't have to ideally really enter at the cheap price, really a person who might seem like an expensive price here is actually a cheap price to the person over here. You see the psychology? So that's why there's not which better way you want to do it, to be honest. And now I really recommend you to try to really invest the most as you can. And for a person who, I would say it like this, if you haven't mastered technical analysis, like seriously, if you haven't mastered, let's say, understanding the moving averages well, don't worry about the moving averages, just do dollar cost averaging, because net in total, you're really not going to make much of a difference compared to the person who's trying to do this. And the person who's doing this might not make much of a difference compared to the person who's not. Why did I show this way? Well, because in sometimes you can get a better return, but it depends. Sometimes it depends. It depends how you do it. It depends on what area. It depends also the amount of availability of money you have. So you have to see which way. That's why I keep saying, look at the way that you can see most discipline with yourself. What's the best way that you can invest? That you have money that you can invest and is more flexible to invest more. Whatever that way is, do it. And that way it could either be dollar cost averaging, or it can be, I call this averaging, really, just averaging the position, right? So you can see that, look what happened though. When you bought here, the price went down more. Of course, anything can happen. But look, you're still receiving money per month. When the price is hitting one of these moving averages, you're going to be entering again and again and again. And when the price is going down below, so this is now the technical analysis too. Also, when you're in a downtrend, I would say enter when the price is overextended from the 20 moving average and when it's showing signs of reversal. So over here, this showed sign of reversal, and a reversal can be when the price is hitting either horizontal support or is completely oversold. Those are the times that you can enter. This was completely overextended. This was overextended. And look, at this time, right? So you just have to enter when the price is either oversold or hitting a horizontal support line. So this is a horizontal support line, right? This looked chances, but it went down more. You see, it can still, there's always that possibility. But net in total, you're seeing that you're actually entering almost a lot of the times. So you see, this is why it's not so different from dollar cost averaging, but you do have a bit more advantage when it comes to entering at a cheaper price in general, not all the time, because remember what I just said. For a person over here in this area, this would seem like an expensive price, but in the future, this person would see this as an expensive price compared to this one. So net in total, this was a cheaper price compared to this is a cheaper price in the eyes of this person. And this is an expensive price to the person over here. So you see the psychology. So that's why it doesn't matter where you enter, because in the long term, this is the long term, the price will be up. The price went down towards that price you bought, but look, in total, the price went down more. It didn't, anything can happen. And plus, this was in 82. This was when there was this was actually the highest inflation there's ever been in the US. Remember when the interest rates went to 20%? This is what caused it. So, but net in total, you kept entering, and you kept entering at a cheaper price, And look, when the price went to a hammer point, you entered here at $103, and look at how it shot up. So you see, you can still make a lot doing this. That's why I said, like, maybe you might make more than dollar cost, maybe, but at the end, I think dollar cost might make you more in total, because it depends. I don't know. It sometimes depends. I think really the person who's doing this is probably doing the same thing as the dollar cost averaging. So really net in total, whatever, which way you feel comfortable, right? And whatever you do, that's perfectly fine, because you might get somewhat a better result or equal to the one who's doing dollar cost averaging, right? And the way how to get better results is to know which one you feel more comfortable with and you understand the most. If you understand the most dollar cost averaging, because you see that that's the sure return, regardless, you see, you can never predict the market. I can never predict that over here that the price can go down. When maybe over here I was anticipating it, but I wasn't predicting anything. And look, I proved to be right. I didn't predict anything, hence the price didn't go to the 50-moving average, and it just kept going towards that area until it did. So you can always be wrong. You can sometimes be wrong on things, and that's the effectiveness on dollar cost averaging, because you don't enter whether you're biased or not. You just enter for entering, right? You need to enter because that's the rule. You enter every month. Hence, you enter whether it's a good time to buy or whatever. You're like over here, many people thought it was not a good time, but you entered because it was like a bank account. You just enter regardless of where the price was. You enter regardless of where the price is. And then net in total, you guys know the effect of dollar cost averaging. You're able to enter net in total. Your account is not going to be able to lose as much. Now, what are the disadvantages and the advantages between the two, between averaging position and dollar cost averaging? The advantage of dollar cost averaging is that in 5 years, it's almost impossible for your account to be negative for an extreme case of the market. Averaging the position, it is possible to have something negative because you're entering at bottom points. You're not entering at any points. So if you're entering at bottom points over here, you didn't enter anything over here. Look, when the price goes down, you can go negative. You see the thing here? But if you would have entered dollar cost averaging over here, over here, over here, this would have not affected you because you would still be positive. That's the advantage of dollar cost averaging. But I don't see that as a huge concern because you're holding this for you're holding this for 30, 40 years. 30, 40 years, whatever. Look, this is at $100. This was an 80. Look, right now it's at 4,000. So it really would have not mattered that the price was going down. You were losing maybe 30%, 20% per se. When in the future, you were making about 40 times the investment. So you see that's not, and more than that from dividends reinvested. So it doesn't matter at all in the short term. That's why I keep saying it's now personal preference. If you're emotional, you don't like to see losses as much, do dollar cost averaging. Do not do this. Like really, if you really don't want to see a loss in your portfolio, you rather it to be steady in the future and make consistent gains, I would 100% recommend you to just do dollar cost averaging. If you don't mind seeing losses and actually being able to entering at a cheaper price and entering more and more amounts, you will be handsomely rewarded in the future with a huge gain, right? But you have to handle those losses, those temporary losses, if you're fine with that. So that depends on personal criteria. They're both really well. And at the net in total, in 10 years, both of you are going to have not much of a huge difference. You both will be extremely positive. Yeah, that's averaging your position. Remember this, I'll have this in a PDF format. Also 2 to 3. You can see that these are actually intervals of 3. Yeah, because it's really taking 50% of this, half of this, right? Half of 10 to 15 is 13%. And then the third position is the lowest. So you can say that in this area, the first time will be 20, and then the half will be half of this, which will be 17. And the third would be the lowest of 15. And it's the same here. This would be half of 23, lowest 20. Half of this, 33, and this would be 30. So you see, like, I'll actually just do that. But in any case, that's how you do it. Now that's per month. That's for a person making money per month. If you make it per quarter, that's now depending on you, right? Per quarter, I would strongly recommend that you should use mostly averaging position if you can get money in a month. If you can get only money per quarter, I would now recommend you to do that more. I would only recommend you to do dollar cost averaging. So what's the whole point? What's the sum of this? So look, if you're going to average your position, do dollar cost averaging only. I'm sorry. If you're averaging your position, have money consistently coming each month. If you don't have money consistently coming each month, but you have it maybe 2 months or 3 months, if your business or whatever you do works like that, like you don't get your money in a month, you get it in 2 months, then I don't recommend you to average position. I recommend you to just do dollar cost averaging, right? So net in total out of all this, dollar cost averaging can be done whenever you get money, because that's the point. You're like using it as a bank account. It doesn't matter. In dollar cost averaging, whatever money comes in at whatever pace at whatever time, you just enter the market regardless of where it's at, right? And that's effective with dollar cost averaging because you're entering where it's at. That's very effective because you can never predict where the price goes, right? If the price goes up, that was the point here, what I just said. If the price was going up, you don't care if it's going up. And net in total, this person kind of regretted they didn't enter somewhere here because it was cheaper. Do you see the psychology? But it would have been riskier. But it's not riskier if you're entering per interval or per quarter, whatever. So whenever you get the money in less than a year, right? In less than a year. For averaging position, only can do it if you can get reoccurring or consistent revenue always every month. If not, then only do DCA, which is dollar cost averaging. That's my rule. Also, one last thing to kind of close this. There's also another part in averaging investing. You can do it. So now that I think about this, right? Well, no, that's actually the end of averaging position, because averaging position, you're averaging the position. So that's the rule. If you cannot get your money consistently every month, but you only see that your business is able to make the profit in 2 months or 3 months or anything above a month, only do dollar cost averaging. I recommend you. If you're investing in a way less than a year, look, I'm going to call this positioning below a year. Yeah, I'll call all this sort of investing positioning below a year. I'll actually put it here. Positioning below a year strategies for index investing. Not just any index, but the S&P. I'll put here the S&P, S&P, because I don't want people to get confused. S&P 500 investing. This is the positioning below a year strategy. All these are these type of strategies. If you can get your money every month, you could, I'm not saying that you shouldn't, but you could do averaging position, right? But remember the criteria. Averaging position is good if you don't care to incur loss in the short term. And that loss can be anything. It could be 40%, it can be 60%. You don't care because you're looking at the long term. But if that does affect your decisions, look, because you may think it doesn't affect you, but if it affects you when you're making decisions and you start to get emotional, please don't do averaging investing and just stick to dollar cost of averaging and don't ignore everything else. Just keep investing it like if it was a bank account, and that's it. This lesson, the past lesson, these are all strategies that you could invest in the market below a year, in less than a year, if that's what you look for, right? And these are all these strategies that I recommend you only to do if you're doing in less than a year. And there's only 2, dollar cost averaging and averaging position. I'd recommend those 2. Those are the most effective. Also, always reinvest dividends. Reinvest dividends always. So if you bought 15% position, that position you should enable. It's called drip. It's called a drip investing. Make sure your drip is on, right? If it doesn't show drip, it just drip. Remember, it means that dividend reinvestment dividend reinvested investment program. That's all it means. So that we've basically already covered up all the types of investing that you can do below a year. In the next lesson, we'll talk about how to invest in the S&P 500 if you're not going to invest in less than a year, but like let's say a year, for example. All right.